Good afternoon, everyone. Welcome to today's lunch here at the Foreign Correspondents Club of Japan. I'm Anthony Rowley, the first Vice President, and it's my genuine pleasure and privilege today to introduce our guest speaker, who obviously is seated to my right, Mr. Klaus Regling, who is the Managing Director of the European Stability Mechanism, or ESM. And to his right is Martin Curling, former director of this club, who has been instrumental in getting Mr. Regling to come and speak to us today. I think, it's particularly good, actually, to have someone here who's so deeply versed in European affairs, as Mr. Regling, to talk to us and lift our sights, I think, above Brexit and beyond perhaps the intricacies of German politics to the wider vision of a united Europe. That vision, despite all of the problems, is still very much alive, despite the splittist and populist tendencies within the European Union. And Mr. Regling is the ideal person to educate us on where Europe stands now with regard to monetary and economic union, and who knows, possibly in the future, political union. He is, as I said, the current and first managing director of the European Stability Mechanism, which was launched in 2012 to preserve stability in the euro area by providing support to member states in financial distress. He wears two hats, or two main hats. He's also CEO, Chief Executive Officer of the European Financial Stability Facility, or EFSF, which was created in 2010 to address the European sovereign debt crisis. The next step along the road is likely to be, or could be, yes, likely to be the launch of a European Monetary Fund, or EMF, Europe's own IMF, if you like, which would go beyond financial bailouts and into a much broader role, including that of acting as a lender of last resort. I suppose the best way to describe our speaker today is a man for all seasons. He worked for 40 years as an economist in senior positions in the public and the private sector in Europe, in Asia, and in the United States, including a decade with the IMF in Washington and in Jakarta. He spent a decade with the German Ministry of Finance, where he helped prepare economic and monetary union in Europe, and from 2001 to 2008, he was Director General for Economic and Financial Affairs of the European Commission. I won't take up any more time. I'll allow the speaker to make his presentation. He will be using a PowerPoint presentation, and you do have copies of the hard copies of it here. At least I hope you do. Let me ask you to welcome our speaker, and if you have mobile phones, please switch them off or put them onto manner mode as a courtesy to our speaker. So please join me in welcoming Mr. Regling.
Yes, thank you very much. Thanks, Anthony. Ladies and gentlemen, it's a pleasure to be here a second time. I was here a few years ago. So I will go through my presentation, talk about CSM, talk about the euro crisis, which is now behind us, and then also the economic situation, the current economic situation in the euro area, the outlook, and talk about what might happen next in our monetary union. So let me start by introducing you to the ESM and the EFSF. So we have two institutions. As Anthony said, the EFSF was created in 2010, very quickly, had to be operational within a few months, and then it was a temporary institution by concept, working under Luxembourg law, but then very soon we realized we needed a permanent institution, and then the ESM was created. Politically and financially they are very similar, so that's why I put them together. Also in a legal sense, they are quite separate institutions. They also act as an issuer of bonds quite separately, these two. But as I said, politically and the mandate and the objective is identical. Together they have a lending capacity of 700 billion euro, so that's quite sizable. It's more than 900 billion US dollars. On our lending side, we operate like the International Monetary Fund. Every lending is linked to conditionality. So countries have to adjust their economic policies to get out of the problems. And they do have problems, otherwise they wouldn't come to us and ask for money. It's the same with the IMF. Only countries that have problems go to the IMF. The last 8 years, or the 7 years, we have disbursed 273 billion euro to 5 countries, to Ireland, Portugal, Spain, Cyprus, and Greece, 5 countries. 4 of the 5 are success stories by now. They left their programs after a 3-year period. That was 2-3 years ago. They all have now above average growth rates, rapidly declining unemployment rates. So they're real success cases. They can again refinance themselves in the markets without any problem. Greece is a special case. They are still under a program. It's the final one. In a way, it's the last case of the old crisis. But there's some chance that they will also become a success case, but they are not there quite yet. The program runs till August. They continue to receive money from us. There's enough money available for them till August, but they already started also going back to the bond market to test it. So they are slowly moving back to a normal situation. And also on the economic side, they have clearly some progress, and I will show you a few slides later on that demonstrates that. Here, this is a summary of the different programs from the EFSF and ESM. I will not go into the details. You can check the numbers. It shows the money that we disperse to these countries. What are the benefits of having this EFSF, ESM? Institutions that did not exist before the crisis. We had an institutional gap in the monetary union. We had no lender of last resort for the sovereign in the monetary union. In a country like Japan, the UK, the central bank can also become the lender of last resort, not only for banks, but also for sovereigns in a crisis. In the monetary union, the ECB is only the lender of last resort for banks. Not for the governments. We play that role now, and the clear benefit has been that we have been able, the last few years during the crisis, to keep the euro area together. There was clearly the risk that some countries would have dropped out. And if the EFSF, ESM had not been created, we probably would have lost Greece, Ireland, Portugal, and that would have changed Europe quite a bit. So that's a clear benefit. Another benefit is that through our programs, I said we only disperse with conditionality, countries move through a reform program, and we know that reforms and adjustment are necessary in these cases, so the countries move out of crisis, but it also means that these countries then have a bright economic future based on those reforms. And that's again very much the experience of the IMF. During the last 50 years, the IMF had some difficult programs in many countries, in Latin America, during the Asian crisis, in Turkey. And this is always painful for the population. It's always the same story. At the height of the crisis, it's very difficult to see light at the end of the tunnel. But then with a time lag, these countries were the best performing economies in the world. You remember Indonesia did very well after its crisis, South Korea, but it's the same applied in Latin America. So that's why it's not surprising that also the countries in Europe that went through a crisis and through these reform programs are doing now very well. That's why they are success cases. What is also important that through our programs we help countries to regain debt sustainability because our lending is very cheap. Our work is guaranteed by all our member states, either through guarantees or through capital. The ESM has a capital of 700 billion euro, so a lot of money brought up by our member states, of which 80 billion is paid in. We have the money actually in our accounts. We don't use it for lending. It's there as a guarantee for our bonds. And that's why we have a very good rating. And with a good rating, we have low funding cost. We always go to the market to raise money first before we disperse. So at the moment, we charge the countries that borrow from us less than 1%. Of course, interest rates are low anywhere. But for a country like Greece, that's a big savings in terms of debt service payments. And in this table, if you look at the second line for Greece, it shows that in 2016, Greece saved in its budget 9.9 billion euro. That's 5.5% of Greek GDP, because our interest rate costs are so low. And that's how Greece can, over time, regain debt sustainability. This is the biggest help program the world has ever seen. That's the solidarity of the euro area with a country like Greece, which in exchange implements reforms. So much about the institutions. Now a few slides on what happened economically in these countries that needed help. Here you see on the left-hand side the fiscal deficits of the 5 countries that received financing from EFSF and ESM. And then there's also Germany as a benchmark. And you see that in 2009-10, there were large deficits. Some of them around 15% of GDP, that was Greece. The one on Ireland was particularly big in 2010, that was the bank recapitalization they had to do. They had to take on into the budget all the bank problems. And all these countries are reducing their deficits. And they are all now below 3% of GDP. And some of them are already in balance. Greece already in 2016 had a fiscal surplus, which shows how big the adjustment was in that country, moving from a deficit of 15% in 2009 to a surplus in 2016. So good progress. There are some ups and downs. It's always very noisy. Fiscal policy is never easy, but the progress, I think, is quite visible. It also means that the euro area as a whole, you see it on the right-hand side, has today a deficit of less than 1%. And that, of course, compares quite favorably what you see and you know about Japan. In the US, the deficit is around 4 to 5%, and now going up with the tax cuts and the investment program. So we are quite happy with that, because it also means that the debt levels are coming down in Europe. They are now below 90% of GDP. In the US, they are already at 105% and rising. And I don't want to mention Japan in this context. It also means we have more fiscal space in case there's a next downturn, which will come one day. So on the fiscal side, we can then react to that. Other countries might have a problem. That was one important aspect, the fiscal side. The next one is on competitiveness, another crucial element that led to the euro crisis. On the left-hand side, you see nominal unit labor costs shown in a cumulative way since 2000. And you can see that, again, the countries that lost market access, that needed help from us, had a much more rapid increase in unit labor costs than Northern Europe. The thick blue line at the bottom, that's Germany, but could also be the average of Germany, Netherlands, Finland, Austria. And in 2009, the difference was like 45% more increase in unit labor costs than in Northern Europe. That was not sustainable. It led to big current account deficits. You see that on the right-hand side, 10 to 18% of GDP. So something had to change. You see the turning points happened in all these countries in 2010, 11, 12. Unit labor costs dropped, because these countries did what we call now internal devaluation, which according to US textbooks, that is not possible. That's sometimes why I think American economists don't understand what's happening in the monetary union. But in these countries it happened. Wages, salaries, pensions were cut in nominal terms by 20, 30%. So clearly very painful, but unavoidable, and in a way the correction of 2 rapid increases in wages and salaries before the crisis, because that's why unit labor costs went up so much more than Northern Europe. The income gains were too fast, too strong. That had to be corrected. As a consequence, competitiveness has been regained in these countries. Current account deficits fell. Some have now current account surpluses. They are gaining market shares again. Exports are doing well. So these two things, fiscal side and competitiveness, explain to a large extent how countries got into the crisis and how they got out of the crisis. Now, just a few slides on where we are now in the euro area in general. On the left-hand side, you see the growth rates. The blue line is the euro area. You see that we had these two dramatic dips, one in 2009 and one in 2012. The first was the global financial crisis, and the second was the euro crisis. But now we are doing well. Growth already last year and probably this year is higher than the United States. That's headline growth. On the right-hand side, you see the better comparison. This is GDP growth per capita, because demographic trends are obviously very different in the US, Europe, and Japan. And if I look at GDP per capita growth, these differences are taken out, differences in population growth. And then you see that before the crisis, GDP per capita growth was the same in the euro area and the US, to the decimal point. And we are back in that situation. Also looking at potential growth rate per capita, it's very similar, which is not surprising because advanced economies get their growth rate per capita from productivity gains, and they are very similar in the advanced economies, not every year, but over time, because technological progress spreads. I think I have to be quick on the next few slides. This one shows that the labor market in Europe is better than many people think. The employment rate has been going up, dropping in the US. Income distribution in Europe, together with Japan, the best in the world. Gini coefficient much, much worse in the US. And China, of course, it's the worst. So we are quite happy with that. In a way, it means that the European social model is able to cope with the unintended negative side effects of globalization better than the Anglo-Saxon model. Banks are catching up in Europe. They are not quite there yet in terms of capital. They are doing well. European banks have added 700 billion euro over the last 10 years to their capital. That has more than doubled. 700 billion euro, a big number. So the capital ratio is fine, but profitability is still much lower than in the US. Several countries in Europe have too many banks and too many branches, so overbanking. There's also a large number of non-performing loans, which of course depresses profitability. You see here NPLs, they are coming down, but they are still around 800 billion euro. More than half of them is provisioned, so it's not completely a problem for the banks, but it means they don't have income on these high number of claims, so that reduces profitability. We have action plans in place in the European Union by the ECB to deal with that. So there's progress, but more work to be done. So overall economic situation quite well at the moment. But we know growth rates of 2.5% will not last. It's about twice the potential growth rate of Europe. So there will be a slowdown sooner or later. Probably not this year, next year, but eventually. There are other challenges, despite the fact that the overall situation is good and that the crisis is behind us. What are these challenges? I tried to put them here on one page. There are political risks, of course. Not as much as some people were afraid of. A year ago, I remember newspaper articles that said the end of the European Union is close because of elections coming up in France and Netherlands, but they turned out to be quite pro-European. But of course, more elections are coming up. Italy on the 4th of March. There are populist parties in almost all European countries. They are not disappearing. They are not as big as some people were afraid of. There's also a populist party now in the German parliament. They will not enter, in most countries they do not enter governments, but Germany shows that to have such a populist party with which nobody wants to have a coalition just makes it much more difficult to form a government, because they occupy 10 or 12% of the seats. and therefore it's more difficult for the other parties to form a government. So, and they influence the public debate, so it is a problem. But it's so far manageable, but it's a problem. There's a threat of protectionism, particularly coming from the United States, that could affect all of us. In Europe, we are still struggling with immigration, with security, with terrorism. Immigration was a big shock in 2015 and 16 because too many people came all of a sudden. We are all used to some immigration in Europe, I think quite a bit more than Japan. But if the numbers get totally out of control, then it leads to political and social problems. Brexit, Anthony mentioned that. I don't want to say much about it because it does not affect the euro area as such. It does not affect the ESM. But of course it affects the European Union because we lose one big member. So politically that is regrettable. Economically, it's mainly a problem for the UK. It's not much of a problem for the rest of Europe. But it also is a problem because it absorbs a lot of energy. On the British side, on the EU side, these negotiations is just very time-consuming, and ideally these energies could be directed towards more productive use. Other problems, given our poor demographics, growth in the future will only come from productivity gains. So the agenda is then clear. In order to raise the productivity level, one needs more investment, but good investment, not only in infrastructure, also in education and training. I think that's a common agenda also in this country. And every country in Europe is working on that. And the last item, I will talk a bit more about that because it affects my institution. There is a debate to make monetary union more robust. We have done many things in the past, like creating the ESM, starting banking union with a common European supervisor, a bank resolution fund. So there is a lot of progress. Monetary union is already more robust today than it was 10 years ago. But there's a debate how to continue this process. And that's good because we see that the euro area does not have the degree of financial integration that we had before the crisis. Risk sharing in the euro area is underdeveloped. And there's a debate about some more institutional change. Here are a few more details. The debate about strengthening monetary union has these three components. On the financial side, we want to complete banking union. And completing the banking union requires two steps. One is a backstop for the Single Resolution Fund. The Single Resolution Fund is being built up now. In a few years, they will have their targeted money volume of 55 billion euro, 1% of our deposits. This is enough to deal with normal crisis. But if it's a big crisis, that money will not be enough. And that's why they will need a backstop for big crisis. We have the same system in the United States, and that backstop will probably be provided by the ESM. There's also a discussion to introduce a common European deposit insurance. Every country at the moment in Europe has a national deposit insurance scheme. But when there's a real crisis, it may not be very credible to organize it at the national level. And therefore, there's a debate to do a European-wide deposit insurance, because if all euro area countries guarantee the deposits in every single country, then it's more credible. So it will probably never be used once we have a credible system. But at the same time, we can only implement it when we have dealt with some legacy issues in some countries, like very high NPLs in some countries, very high amounts of sovereign bonds in the balance sheets of some countries. Also, some national schemes are not fully funded yet. So there's some work to do. But once that is done, then we will very likely move to European deposit insurance. Creating a capital markets union is another important topic. we don't really have a fully integrated capital market at the moment, not in the EU, not in the euro area. They're really still national capital markets because of different legal systems, different tax systems, different insolvency regimes. And so there's a very broad agenda to make progress here. It's not easy because insolvency regimes, for instance, developed in very different directions over hundreds of years. So to bring them together, to harmonize them, is not easy, but it would be very useful. So it's good to have it on the agenda. On the fiscal side, there's also a broad debate what to do. There are many ideas on the table, and so far there's not much consensus what is really needed. So I tell you what I think is needed, and I start with what I think is not needed, although there are many proposals in that direction. I don't think we need more transfers in the monetary union. There are many people who say there have to be more transfers, otherwise it would never work, particularly in the academic world. But they forget that we do have transfers in Europe. They have been around for a long time, much longer than monetary union, and it flows via the EU budget. The EU budget is small, it's 1% of GDP, but it has always been designed since 1957 in a way that richer countries pay in more than they get out, and poorer countries get more out than they pay in. And for the small, poor countries, this is quite sizable. They get every year net transfers of 3 to 4% of their respective GDP. So there are these transfers. And that's useful because we want to have real convergence of living standards. And that's what can happen if these transfers are used productively. So one could add to that, but it's not as if we need to invent something completely new. There's also, in my view, no need for any fiscal facility for big symmetric shocks. It's something that some have suggested, even the IMF has proposed it. I think it's not needed because Europe demonstrated quite convincingly in 2009 after the global financial crisis hit us, what to do when there's a symmetric shock. All countries decided to simultaneously increase their fiscal deficits. So there was a fiscal expansion in all countries. This is even allowed under our fiscal frameworks, the Stability and Growth Pact. It allows such an action in exceptional circumstances. So if there's another big crisis, and the one in 2009 was the biggest we had in 80 years, this could be repeated. So no need for that in my view. But what would be useful is are three things. One, to simplify our fiscal rules. They have become so complicated that there's hardly anybody left to understand them, and that is not good for credibility. Then I think one type of fiscal facility would be useful, and that would be to deal with asymmetric shocks. So contrary to symmetric shocks, macroeconomic stabilization. And I think that is useful because in a monetary union, the central bank, the ECB in our case, cannot intervene for one country, on behalf of one country when there's an asymmetric shock. That's why it's good to have more fiscal tools available. And the final point on the fiscal side is that we have a debate how to make sovereign debt restructurings more transparent, predictable. Not that we want to have more, but what happened the last 10 years that we had very much ad hoc decisions and not a real transparent system. At the same time, I'm not in favor of any automatic restructurings, as some countries have proposed, a small minority. So that's on the fiscal side, so a wide agenda, and I don't expect any agreement on that already middle of this year. On the financial side, the backstop, I think we can have decisions in the middle of the year. Finally, on the institutional side, there's a debate to develop the ESM towards the European Monetary Fund. although the name European Monetary Fund is not really needed. It just means that the ESM would get more mandates, including providing a backstop, including, and there's a broad agreement on that we would play a broader role in crisis management. So far, we have mainly provided financing, and the European Commission with the IMF and the ECB was in charge of putting together the program, the conditionality. We are now getting involved in that, so that would be a new mandate. And finally, there's a debate about having a European finance minister, which I think will only be useful if there's more agreement on these fiscal topics that I mentioned. So that's what I wanted to say. There's a final slide in the package. That's maybe for some financial journalists, just to see what we are doing at the EFSF, ESM on the funding side, our bread and butter operations. We issue bonds every year. Last year we issued bonds for 61 billion euro. We also issued our first non-euro bond in US dollar. Here you see the numbers, but I will not talk about that because that's, unless you have questions, because that's more for specialists. So that was my introduction. I hope I was not too long. No? So happy to answer your questions.
Thank you very much, and thank you for your comments. I have a question myself, if I may, and my question is very simple. What about the elephant in the room? What do I mean by that?
Which elephant?
Well, it's a four-letter word, and it's called debt. The front page of the Financial Times this morning gives its lead to the fact, a warning by the OECD, that government debt has now reached a very high level, something like $48 trillion on a global basis. Debt is huge now. I mean, $233 trillion worth of debt in the world, a large part of which is in the government sector and a very large part in the corporate sector too. So, and this is occurring at a time, this debt mountain, if you like, is occurring at a time when we're about to enter a period of rising interest rates, presumably. Aren't we all rather complacent? Doesn't this, I'm being a bit of devil's advocate here, but doesn't this signal to you the possibility of a further shock, a further financial shock, not necessarily in Europe, but in other parts of the world? What's your general assessment of the threat?
Yeah. No, you're right. Debt is very high, and not only for governments, but also for corporates and private sector. Of course, the situation varies very much country by country. So it's also private sector, actually, because in some countries there's very high mortgage debt. But situation is very, very different. Obviously, you all know Japan has the highest public debt. I mentioned already that in the euro area, public debt is falling and has been falling already for 2 years and is on a clear downward trend while it keeps growing in the US. Corporate debt, there the US is doing better. They had some deleveraging, but there are some European countries where it's quite high. Private debt, also high in some European countries, not all. Europe has, Germany, for instance, has very low, relatively low private debt. In the US, again, it's high. So it's quite different, but in general, it's high. And in many cases, it's the highest since World War II. So at least on the public side, and I'm more a public sector person, I'm glad that in Europe we have been following our fiscal guidelines, the Stability and Growth Pact, to bring this down. And this was quite often contrary to recommendations from the OECD and the IMF. So I'm glad that the OECD is turning around and also realizing that this is getting a bit out of control in some countries. I think it was very much appropriate during the crisis in 2008 and 2009 to increase fiscal deficits because there was a real crisis, and that was the moment to do something with all policy tools available on the monetary side and on the fiscal side. But now that growth has been good, above potential in most advanced economies, I think that is a moment where fiscal consolidation has to happen, otherwise it will never happen. What does it mean when interest rates will go up? And I think markets expect In the US, a continuation of the increase. They already had 5 steps of increasing interest rates. Markets expect, I'm not making any forecasts, I only report what markets say. They expect 3 more steps this year and then more in 2019. In Europe, in the euro area, markets expect an end of the bond purchasing program later this year and the first increase next year. Again, this is a market expectation. So there is a general expectation that interest rates will go up, but there's also the expectation that they won't go up very much. Those who were at the conference of the IIMA yesterday, we had a debate about the natural interest rate, and although there are many different views about the natural interest rate, but most people take the view that it's lower today than it used to be. And although it might go up again, it will be lower. The new normal will be lower than the old normal. So I also would share that view. We will, over time, see high interest rates, but not dramatically higher. But then everybody who has debt, of course, will have to pay more interest rates. For the public sector, many countries, particularly those with high debt like Italy, for instance, in Europe, have used the last few years to lengthen their average maturity. In Italy, it's now 7.5 or 8 years, which means whatever increase in interest rate happens, the full effect will only show up after 8 years. So therefore, there's time to prepare for that. Actually, the Italian finance minister said that himself last week. He said, we know interest rates will go up. It will be a higher burden, but we are prepared for that. The French finance minister said something very similar a few days ago. So it's an issue, but at least on the public side, finance ministers are aware of that, and given the relatively long maturities, in my view, it's not a reason to expect a crisis.
Well, that's reassuring to know. Okay, yes, Richard, you please. Please introduce yourself, please.
Yes, Richard Smith for the daily newspaper, The National of Abu Dhabi in the United Arab Emirates. I don't understand what the role of the EMS is next to the IMF, International Monetary Fund. Does it work in concert with it or independently? How does that jibe?
Yeah. Yes, let me explain a bit how the IMF gets into all of this. So when the crisis became serious, the euro crisis, which was the second crisis in a row after the global financial crisis, and member states of the euro area lost market access, we were not prepared for that. There was no EFSF, no ESM. And in general, people that created the euro in the late 80s and then in the 90s could not imagine that a country after joining the euro area could lose market access. That was unimaginable. Also, I had not thought of that kind of problem, because it's not easy to get into monetary union. There are several hurdles, conditions have to be met. So this was new. We were not well prepared, and it was quite important to get the IMF on board at that time with their money and with their expertise. We needed their money also because the EFSF was completely new. We didn't know how much money we could raise in the markets. If somebody had told me that in 2017 we would raise 61 billion euro in the markets by issuing bonds, I would have said it's totally impossible. But we have learned how to do it. We have become credible in the market. So money is no longer an issue, but it was very much needed in the beginning. And in the early years, the IMF contributed 1/3 of the financing. Then later on in Cyprus, the second Greek program, the IMF contributed only 10% and we provided 90%. And now in the current Greek program, they have not given any financing so far. But that's fine because we can mobilize the money ourselves. also the expertise of the IMF was very much needed because we had to learn how to do that. A country that needs to adjust and have conditionality. The IMF has this experience from around the world for over 50 years. Now the European Commission has learned it, we have learned it. The way it was organized is that we had a European program, EFSF, ESM program, where the European Commission, the ECB, and we worked together. And the IMF program was put up in parallel. So they had their own program with their own financing in the beginning. But of course, we made sure that the conditionality was consistent. So that would have been impossible to have the IMF saying that they want something and the Europeans tell the Greeks something else. So we made always sure that we worked very well together. Although legally, this is a separate program because the IMF has its own board, its own governance structure. So they can only approve their own programs. They cannot approve European programs. So it was sometimes a bit complicated because it was also a new approach. But in the end, it worked quite well to have two programs in parallel.
Thank you. Yes, please.
I'm Sawaki Kita, working for the Asahi Shimbun. French President Mr. Macron proposed to create a common budget within the Eurozone. What do you think of his proposal? And do you think there is a chance that the other countries will accept his proposal? Yeah. Thank you.
Yes, thank you very much. So that is one of the many fiscal proposals that we have. And President Macron, in his very important speech in November, presented a number of ideas how to develop the European Union, the euro area. And this was only one of several of his proposals. So the idea, at the moment, we do have an EU budget. So for the 28 countries, when the UK leaves, and it will be 27 countries in the European Union. So there we do have an established budget. The euro area as such does not have a budget so far. So that would be a big institutional step to do that. And at the moment, I don't see that there's a consensus to reach, to go in that direction this year. It may happen over time, but at the moment, there's not too much support for that. But there are other ways to come to very similar results. The Commission, for instance, has proposed that some of the EU budget should be dedicated only to euro area countries. That would then have a similar result. There's also the question for what is the money used. If it's for financing annual expenditures to protect our common borders, then it can be done in the EU budget. If it is to stabilize macroeconomic divergences, a macroeconomic stabilization budget dealing with asymmetric shocks, that could also be done through an ESM facility, for instance. So therefore, when you mention this particular one, it falls into a range of different proposals and ideas, and we may do something in that area, but I would not expect a real euro area budget this year already.
Okay. Yes.
Siegfried Knittel, freelancer from Germany. I think it was mostly Germany who was against financial integration and the European household. In the former Finance Minister Schäuble he said always, every country has to be responsible for his own money. And do you think under a new finance minister from the Social Democrats, this policy will change?
No, but I think you don't describe well what Mr. Schäuble's views were. There is a EU budget. So when you said European money, we do have a EU budget. Mr. Schäuble, the former finance minister, was instrumental in putting up the EFSF. He talked already in 2010 about a European Monetary Fund. And he also said a European deposit insurance scheme is useful for monetary union. However, he said very strongly, certain conditions must be in place first, but he was not against that. So Schäuble was in favor of many of these things. I think otherwise it's a wrong impression. But you are right that Germany in general is conservative on the fiscal side. Germany itself runs a fiscal surplus, one of the few major economies in the world that has a fiscal surplus. There are a number of small European ones that also have a surplus, like Malta and Netherlands and some others. But in general, there is a broad consensus in Europe, in Germany, to be conservative with the German finances, but also with the European finances. So the Stability Pact was developed in Germany, so that's close to the German government. And I don't believe that a social democratic finance minister will change that. And the first statements from Mr. Scholz clearly indicate that he would not want a fundamental shift. The coalition agreement, which we have, we can read it, clearly says that for Germany, the balanced budget will continue during normal economic times. It would be different if there's a recession, of course. But during normal economic times, both of the parties support to have a balanced budget or a small surplus. And they will also be very careful on spending any money on European issues. By the way, nobody in Europe who has anything to say is proposing to increase transfers. Some German newspapers sometimes claim that there was a request for more transfers, but it's not true. Not Mr. Macron has proposed it, nor the European Commission. So there are some wrong perceptions here also. But your main question was, will anything change in Germany? And I think fundamentally on these issues, not.
Just picking up on that, you said that Germany is a conservative society, which of course is true. Japan is normally thought of as being conservative too, and yet there's a huge fiscal deficit in this country. How does Japan manage? Is Japan justified in feeling comfortable with such a large fiscal deficit as it has at the moment?
Well, I think the big problem is not the current deficit, but the amount of debt. And of course, the deficit adds to that. I think the rest of the world is always a bit surprised that interest rates are so low despite the high debt. But economists know that the explanation lies in the very large amount of national savings, and that that Japanese savers have a strong preference to invest in their own country. And that explains how this large debt and the low interest rates are compatible. It's something we don't see in any other country in the world. So it is a little bit of a phenomenon.
More questions? You have a question? Yes, yes. Does it?
Hi, I'm James Mager from Bloomberg News. I have two questions about the example of Japan. First is, there's been a long debate in Japan about the deflationary effects of demographic change and a shrinking population. And you said that Europe's demography is sort of going the same way as Japan's, especially in the Western European countries. Do you think that a shrinking population or the demographic change that both Japan and Europe sees is inherently deflationary, and do you expect that to happen in Europe? And the second question is, in 2006, 2007, Japan was looking to raise interest rates it ended quantitative easing, the first round of quantitative easing, and then obviously the financial crisis happened and rates were then getting cut, and then they restarted quantitative easing. And there's obviously a debate you spoke about how far rates can rise. When the next crisis happens, or when the next recession happens in Europe and the US, do you see that what the ECB will do and what the Fed will do will be the same as what Japan was forced to do during the crisis 10 years ago, is to go back and restart QE, to go back and cut rates further than they are, or further than the point at which they've risen in the next couple of years? Thank you.
On your first question, yes, I think in Europe we see similar phenomena. I wouldn't call it deflationary. There was maybe a risk 3-4 years ago to have some deflation, but we moved very clearly out of that in Europe. But we do have the phenomena of low price increases, low wage increases, that's a little bit what you find all over the advanced economies. And in light of the strong economic expansion and the low unemployment rate and labor shortages, it's surprising that wage increases are so low, that inflation is so low. And it's something economists try to understand, and I think we have to admit that we don't fully understand it. The Phillips curve has changed, it's not the way it used to be. But aging is one of the explanations for all this. And Europe we have demographic problems, we have aging. It's not as pronounced as in Japan. Europe is somewhere between the US and Japan. But we do know that also the population, and particularly the working age population, will shrink in Europe. Here it's already happening. It will happen in Europe. It's unlikely to happen in the US. And that has an impact on, I wouldn't call it deflationary, but contributes to lower inflation, lower wage increases, lower growth, because growth in the end is a combination of labor input and productivity gains. So if the labor input is zero or even negative, growth rates are lower. I already mentioned the natural interest rates earlier. So it's one important factor to explain the drop in the natural interest rate. So the answer in the end is yes, we see similar phenomena, less than in Japan, because the demographic trends are not quite as strong yet as they are in Japan. Your second question is very hypothetical. I say now that we are in boom conditions, very good economic situation to explain how monetary policy would react to the next crisis. That's not part of my daily thinking. So I think central banks have demonstrated the last few years that they have an arsenal of weapons that is much broader than many people had expected. Whenever there's another crisis, of course, they will use it again. But I think that's not for the next 2 years or so.
Okay. Is there any more questions? Yes, please.
Hi, I'm Kazuo Nagata of Yomiuri Shimbun. I'm an old Brussels correspondent. I was there 20-some years ago. And the next year, I believe, will mark the 20th anniversary of the launch of the monetary union. Will there be any festivity planned? And, so will there be, and are you expecting any new member to Euro in the near future? And one question. So the founding fathers of Euro, one by one, are no longer with us. Chancellor Kohl, President Mitterrand. But if you have any news about how Monsieur Delors is doing these days, because I interviewed him once, and I was wondering how he's doing right now.
Ooh, sorry.
Monsieur Jacques Delors.
Jacques Delors, okay. Yes, well, first, if you lived in Brussels, you know all of this very well. And we will have the anniversary in 20 years. The 20 years anniversary on the 1st of January 2019. So we have come a long way. We had a crisis in between, but I have been saying for many years when the crisis broke that it's like when you have children. The first decade is normally quite easy. You may not realize it when it happens, but it's with hindsight. The second decade can be quite difficult sometimes. But then from the third decade on, life gets pretty easy again. So I'm looking forward to entering this third decade. We may be on a good way here. New member states, I have no doubt, will join monetary union. Already the last few years we have seen quite significant expansion. When monetary union started 19 years ago, we were 11 countries. Today we are 19. So that already shows an increase from 11 by 8 to 19. Quite a number. There are still, so we are 19. The EU without the UK is 28 countries, so there are 9 countries left in the EU, and a country has to be in the European Union to be able to adopt the euro. Denmark has an opt-out, so they have no obligation to join. But all the other countries, in a way, there is an expectation that they will join one day. Of course, nobody will be forced, but I think over time they will all join. There are 2 countries that are at the moment very actively trying to join within a foreseeable future. That's Bulgaria and Croatia. They have to meet certain criteria. The others have not stated clearly any time frame. So big countries like Poland, Czech Republic. But I think they will all join over the next 10 or 20 years. So the euro area will continue to grow. And your last question was on one of the founding fathers. There are some other founding fathers like Theo Weigel still alive, the German finance minister, very much alive. Jacques Delors is getting a bit old and he's not very active. He must be in his late 80s. So he is alive, but I think he's not so well, and therefore you don't read and hear from him very much.
Can I just... Sorry, you have a question? Are you sure? Okay. You do, please, go ahead. Yes.
Hello, I'm Mario Klein from news agency AFP. I have a couple of questions about Greece. Technical discussions should begin soon about Greek debt relief. I would like to have your position or the EMF position on that. And another question, do you think Greece will be able to refinance itself on the market this year? Because there is some debate on that. Thank you.
Yeah. No, I was wondering why nobody had any question on Greece. So, because it's the last important case that we have from the last crisis, as I said. So debt relief, of course, is nothing new. Greece has received significant debt relief over the last few years. In 2012, the private creditors had to accept a big haircut, the biggest haircut in history, more than 50%, more than 100 billion euro in losses for the private creditors. And the official creditors did what they normally do when haircuts are unavoidable for private creditors. They provided fresh money and improved the lending terms, so maturities were extended, for instance. And all this helps Greece already enormously since 2012. You remember in the one table I showed you that the Greek budget saves almost 10 billion euro every year. That is a result of the relief we give them. But you are right, there's a discussion about additional, but it's additional debt relief. It's not the first time, it's not new. And the Euro area finance ministers have been saying for 2 years that they are prepared at the end of the program, which is in August this year. They will look at the debt situation of Greece, and if debt sustainability requires additional debt relief, they are prepared to grant that, provided Greece continues with its reforms and doesn't backtrack. And there the technical work has actually started, so that we are ready by the summer when the program ends to make this analysis. Is it really needed? And if it's needed, what can be done? It will not be a haircut, but it would consist of additional debt relief if that is needed. So that work is going on and the commitment is there. And because Greece has continued with its reforms, that condition is also met. So that is ongoing. Refinancing, yes, when the program ends, Greece will be on its own again and has to refinance itself in the markets, just like Portugal, Ireland, Cyprus did when their programs ended. And Greece is also doing what these other countries did. They are not waiting till the last moment to re-enter the markets. They went to the market last year and issued on 2 occasions 5-year bonds very successfully. And about 2 or 3 weeks ago, they issued a 7-year bond for 3.5% interest rate, and it was heavily oversubscribed. So it has been working. So they will continue to do that, test the market, get some market financing while they continue to draw money from the ESM. But that's the right approach. That's also what the other countries did. Slowly demonstrate that they are able to refinance themselves completely in the markets, which they have to do from September onward.
We are actually up against time, but I wonder if you'd permit me to ask just one more question to take advantage of your expertise while you're here. What about Asia? I mean, countries in Europe have the comfort now of knowing that the EMS is there if they run into trouble, and the EMF will be there. But here in Asia, we never did really get an Asian monetary fund, as proposed by Mr. Sakakibara. We got something called the Chiang Mai Initiative, multilateralized, but it's been remarkably quiet. As far as I know, it hasn't done anything at all yet. And you did spend 2 years, I think, in Singapore, so you do know about these things. Do you think that the Asian mechanism is ready to be up and running should a crisis occur in this part of the world?
Yes, I know that quite well because we are in close contact with our brother institution in Singapore, AMRO, which is the think tank connected with the Chiang Mai Initiative. AMRO also became an international institution about a year ago. So they do the expertise, and this is very important to have a neutral institution that can make analysis, look at member states and see how the economic situation is, because if a group of countries is willing to provide financing to one of their members, they need a neutral body that makes the analysis and a recommendation. It cannot be a national report. So I think this was an important step to make Chiang Mai initiative, the Chiang Mai arrangement, indeed more operational. It has been operational for some time, but I think this step to have an institution linked to it to do the thinking and the analysis is very important. There are another, we call it now regional financial arrangement. The ESM is a regional financial arrangement in Europe. AMRO together with Chiang Mai is a regional financial arrangement for Southeast Asia, ASEAN +3. We have similar arrangements in Latin America, in the Middle East. We actually started meeting from time to time to learn from each other because we have similar problems, challenges, and we can learn from each other. And we all discuss how to cooperate efficiently with the IMF. Every regional financial arrangement has a different relation with the IMF because everybody's set up a bit differently. To draw money from the Chiang Mai Initiative always requires an IMF program. And therefore they are in very close contact. Also in Europe, we have our experience with the IMF, which is also useful to understand for the others. So it's an interesting development that we have another layer within the global financial safety net with the IMF in the centers and regional arrangements, national foreign exchange reserves. But to answer your question, absolutely, in my view, Chiang Mai and AMRO, they are ready in case of need.
Again, that's comforting to know. Thank you very much. Well, thank you very much indeed for coming. I'm sorry we couldn't match yesterday's conference in terms of numbers, but what we lack in numbers, we certainly, I think, have in interest. Thank you very much. As I said, please, I know this is not the first time you've spoken here, and I'm sure it won't be the last. Please come back soon and talk to us again, and allow me to give you a 1-year honorary membership to the club to encourage you to come back soon. Thank you very much.
Thank you. So I can come and have lunch and enjoy the view.